Now let's look at the second question. Accounting theory, therefore, as indicated by Hendrickson, represents the coherent set of hypothetical, conceptual, and pragmatic principles, forming the general framework for a field of inquiry. In fact, by the time you finish reading this question, then all the words in your mind, all the words in your head to put down for the answer is gone. Because the terms are heavy for some people. And some people, because they started reading these heavy grammatical expressions, then they get confused. Then their mind begin to go far away. Where are they going to get the answers from? But you must take your time and carefully read the question. In fact, the answer to the question is in the question you are reading. So let's start. Accounting theory, therefore, as indicated by Hendrickson, represents the coherent sets of hypothetical, conceptual, and pragmatic principles, forming the general framework for a field of inquiry. With reference to the above assertion by Hendrickson, critically examine the various methods adopted by Hendrickson and others in the development of an accounting theory as basis for the development of accounting principles and policies. That is what the question is asking you. You are to critically examine the various methods adopted by Hendrickson and others in the development of an accounting theory as a basis for the development of accounting principles and policies. Now, we have three methods. We have three methods. The descriptive theory, the normative theory, and then what you call the agency theory. The descriptive theory, the normative theory, and then the agency theory. Now, I'll explain them one by one. Now, when we talk about the descriptive theory, the theory is an explanatory theory. So when I say, what is your name? I want you to, I'm describing. How old are you? So the theory gives an explanatory value to issues. And the theory is dependent on what is. Anything that the question is, what is, forms part of the descriptive theory. So anything that you hear, what is, know that the answer you are giving is a descriptive answer. Before you finalize your proposition, you must be able to get in touch with the environment. And then based upon that, you can now form an opinion. So the descriptive theory is saying that before you can come out with an accounting policy, or before you can come out with an accounting principle, unless you ask the question, what is? And if you don't ask the question, what is, how are you going to get that answer? And the answer is from the society. You are currently doing your research work, and in 1.3 or 1.4 of your chapter 1 or in your proposal, you have what you call the research question. If you don't ask the question, how are you going to get the answer to the research objectives? And the question we are going to ask is from people. We are going to get the question from a population. We are going to get the answer from the society. So they are saying that if you don't ask the question, if you don't get in touch with the society, you cannot get an opinion. That is what the descriptive theory is saying. They are also saying that the methods adopted made the assumption that before you form an opinion, study the environment first, because the environment is a dynamic one. Because the environment is, we just learned about the changing environment. So if we know that the environment is a dynamic environment that can change today, we wake up 2019 to 2018. Nobody knows COVID-19 will be so grateful like this that we'll be in house by now. You have never imagined in 2019 when you were praying in church to cross over to 2020 that you stay in home. But today here we are, because the environment is changing. And because the theory you are bringing out is going to affect the environment, you must first of all get in touch with the environment and ask the question, what is? That is what the descriptive theory is saying. The normative theory. The normative theory also depends on what ought to. So while the descriptive theory is asking question, what is? The normative theory is asking a question, what ought to? What ought to? So what is the subject matter of accounting? And when we know these things, then we can now base on that to formulate an idea which will guide what? The subjects. They also believe the environment is ideal. So whilst the descriptive theory people believe the environment is a changing one, the normative people believe the environment is not a changing environment. The environment is an ideal environment. In fact, the environment is a stable environment. What you see in 2018, you see the same thing in 2020. That is what they believe in. So they just look at the subject matter, and then that's it. Debit the receiver, credit the giver. That's all. They don't look at what the environment, because the environment, no, they hold the environment constant and look at other factors as independent. That is what they look at. They look at other factors before they bring out their proposition. But the first people, they hold other factors constant and look at the other ones. And then they look at the environment. Sorry, that is what it means. So the normative and the descriptive are opposites of each other. Now, when you look at the agency theory, the agency theory formulates, or they formulate theories and principles from the basic assumption that we have what you call the agency principal relationship. They look at that, okay, there is an agent, there is a principal. What relationship exists between the agent and the principal? So the owners of the business are there. They entrust the business in the hands of the manager or the CEO, and then they run the business for them. What relationship is there? And it is based on those things that they use to formulate their accounting proposition. They say that attempts to describe financial accountants and accounting theories from which they originate, and to explain this development based on the economic theory of prices, public choices, and economic regulation, have been grouped under the title agency theory. This theory attempts to offer a consistent and relatively competent explanation for accounting theories and standards. The basic assumption of this theory is that individuals maximize their own expected utility and are resourceful and innovative in doing so. Therefore, all the disclosure issues raised by this theory is a particular individual expected benefit from a particular course of action. This is expected benefit of a manager or a stakeholder vis-a-vis corporate decision. Included in the theory is the fact that there is a total conflict of interest between the owners of a firm and management, in the view that each one of them desire maximum benefit at the expense of each other. So whilst the management are also looking at ways and means to also maximize their wealth and things, the owners are also looking at ways and means to maximize their wealth. And these are the two main variables these people base on to also formulate their theory. So if they are going to bring in any accounting theory, or they want to formulate theories, it will be based on this. And it is based on the agency theory. That is why we have auditing. It is based on the agency theory. That is why we have auditing. So that everybody will be clear. Nobody is cheating anybody. That is it. So this plain the question you've seen over there, just 3 answers. Short. And then you are done. If you have any question, you ask. And then I'll gladly answer you. Now, let's look at the next question. There has been a long debate between the economists and the accountants with regards to what actually constitutes income of an enterprise. Comment on this debate as generated by these professionals and show the extent to which you agree with them. So the economists and the accountants, what the economists call web, Adam Smith, what Adam Smith and his people call web, is different from what the accountant also call web. So when you talk about income, the economists will tell you, hey, the money in your pocket is your money. That's the income to you. In fact, when you go to the churches and you mention income, it is different for them. When you come to the accountant does not just see the money in your pocket as an income. Even the money in people's pockets is an income. Once it belongs to him, it's an income. That is what we mean. So the debate has been between the two of them. Now, as a judge, do you agree with the economist's definition of income or the accountant definition of income? Now, my submission is quite long, so I'll read it. And as I read, you take note of the salient points. Now, accounting income is operationally defined as the difference between the realized revenue arising from the transactions of the period and the corresponding historical cost. So I'm explaining accounting income. I said accounting income is defined as what? The difference between the realized revenue and then the historical cost. We learned in accounting concepts that income is realized not when it is received, but when it is earned. We said that you don't just say that when you receive the money, now you have, at the time You earn income at the time you realize it. So immediately I sell the item to you, or I render the service to you, you are owing me. So income is earned, whether received or not received. Once the transaction has gone through, the income is earned. That is why you have credit sales on your books. That is why you have cash sales on your books, and you merge the two and make it sales. That is why you have costs in your books. You have outstandings, you have accruals, you have owings. You have some of the expenses you have paid, some you have not paid. But you group all of them and consider them what? Expenses. That is why you have creditors on your books, because you bought on credit. But you realize it, or you indicated it as a cost of sale, though you bought a thing on credit and you bought some on cash. So the accountant does not really define income as the physical cash in your hand. No. Once it belongs to you, it is an income. Accounting income is based on the actual transactions entered into by the firm. We just learned that accounting records historical record. And once the transaction has not happened, you cannot record it. So once the transaction has happened, you record. So let me take it again. Accounting income is based on the actual transactions entered into by the firm. That is, revenues arising from the sale of goods or services, minus the cost necessary to achieve these sales. So the sales you have made, how much it costs you to make those sales is the cost of sales. So the things you have sold, how much it costs you to buy them is the cost of sales. So once you take the cost of sales from the sales, you get the income. That is how the accountant defines income, or that is how the accountant sees income. Accounting income is based on period postulate and refers to the financial performance of the firm during a given period. Accounting income, so when the accountant is talking about income, he's not, if you say income, he means income from January 1st to 31st December 2020. He is not talking about income from 1942 to 2020. No. So if the accountant says the income, he means an income for a specific period. That is what they mean. Accounting income is based on the period what? Postulate. Accounting income is also based on revenue principle and requires a definition, measurement, and recognition on revenue. I just explained the revenue recognition principle. That you recognize revenue not only when they are received, but at the time they are earned. So revenue is earned whether received or not received. Once the transaction has been entered into, revenue is earned. The recognition of revenues and consequently income. Accounting income requires the measurement of expenses in terms of the historical cost to the enterprise, constituting a strict adherence of the cost principle. So when we are talking about accounting income, or the accountant is defining accounting income, and you don't talk about the revenue principle, accounting concept, you don't talk about the revenue concept, you don't talk about the cost concept, we are out. Accounting income is the revenue concept and the cost concept. That is what we mean. Accounting income finally is based on the matching principle. So what are you doing? You are matching revenue against cost. So when I said accounting income, you are talking about three concepts now: the revenue concept, the cost concept, and then the matching principle. You match revenue against cost to get accounting income. So when the accountant is talking about income, he's talking about what? The matching principle. That is what we mean. According to what constitutes an income from the economic point of view. So now I'm going to explain how the economists see accounting income, economic income or income. Example, Mr. Kumi, how he will explain income for you. Adam Smith was the first economist who defined income as an increase in wealth. Adam Smith said that, hey, income means increase in wealth. So if 5 years ago you are earning salary 100 Ghana, today you are earning 1,000 Ghana cedis income. But once your wealth is increasing, is income. So the amount of increment on your wealth is the income you are talking about. So the difference between the 1,000 and the 100, the 900 is the income Adam Smith is talking about here. Now, Alfred Masha, in particular, followed Smith's concept of income and linked conceptualization to business practices. The accountant is saying that income is about revenue and cost. The economic aspect of income is full of what? Objectivity. Because what is worth to somebody may not be worth to another. So if today they are paying you 2,000 Ghana and you are jumping over the rooftops, despite who command 2,000 Ghana, despite will not jump over the rooftops. Because 2,000 Ghana cedis for despite is like what he can give to his girlfriend to go and buy water at the roadside. But you want to give you 2,000 Ghana cedis right now, you'll be jumping over the rooftops. So what you consider income, somebody may not consider income. Somebody will be fighting with their mates over 10 pesos in the car. But will you? So the amount of the premium the person placed on the 10 pesos is more than the premium you place on the 10 pesos. That is what the economy is saying. Fisher, I should have asked you the names of some of the economists to see if you could have remembered them. Fisher also defined economic income as a series of events that correspond to different states. So the enjoyment to psychic income, the real income, and the money income. Psychic income is the actual personal consumption of goods and services that produces a psychic enjoyment. In fact, once you are in a state of comfort, oh, I'm okay, yeah. You go to the mall, you go and enjoy yourself, you go and buy pizza, you eat, you are okay. Once you have that state of mind, of calmness, that I'm okay, alone is what Fisher is talking about. Now, let's continue. In fact, Fisher is talking about your inner mind. So once you have the satisfaction that I'm okay, I don't need anything. As I'm here, I don't need money. You don't need anything. You are okay. It means, yeah, that's it. That is what Fisher talks about. So Adam Smith talked about increase. Alfred Masha also talked about the concepts of wealth in a different perspective. Fisher also talked about the concept of income in a different perspective. Finally, the economists also define income as an event that gives rise to psychic enjoyment, that is real income. So the economists, they are seeing the income as the money in your hand. In fact, once you don't hold that money and say it is for me, you can't consider it as an income. They argue that real income is the best measurement by the cost of living. In other words, the satisfaction created by psychic enjoyment of profit is measured by the money. In other words, the purchasing power. So the simple and short is that whilst the accountant sees income as the difference between cost and revenue, the economist is looking at your bottom. Look at your pockets and see how much you can use to afford to buy something. So if you have the purchasing power, then you have, if you have the purchasing power, then you are considered wealth, or you can consider yourself having an income. That is all. If you have any question, you can ask me in the next 1 minute. What do you understand by the term monetary items and non-monetary items? I know this one there, if you are reading the book by now, you have not gotten there. But I'll explain them to you and you understand. What do you understand by the term monetary items and non-monetary items? Now, I think it is somewhere in your handout. I don't know the page. Well, after accounting income, you just go forward, you will see them. When we talk about monetary items, we are basically talking about transactions that are fixed by contracts, or by their nature, they are expressed in CD value, regardless of the changes in price level. So if I come and take loan from you and the interest rate is 20%, you said the interest rate is 20%. If today interest rate has dropped to 2%, I'll still pay 20%. That is a monetary item. If I come and take loan from you and let's say it is $1,000 and the rate was 5.8 by then, and today I'm coming to pay you $1,000 and the rate is 5.2, I'll pay you at the rate 5.8 because we agreed on that rate 5.8. That is what we agreed on. So there are transactions that are fixed by contract, or by their nature, they are not affected by changes in prices of goods and services. So when prices of goods and services have changed, they don't affect them. So for example, your school fees, at the beginning of the semester, they charge you, pay this. Whether prices has gone up, prices have come down, you are in lockdown, you are not in lockdown, they say you pay. That is what they basically mean. I think the time is still getting, okay, I'm left with 8 minutes here. So I can use the 8 minutes to finish this particular one, then you can go to another one. So when we talk about monetary item, this is basically what we mean, okay? But non-monetary items or non-monetary transactions, these ones, they are not fixed by contract. So prices of goods and services can affect them. Now, the monetary and non-monetary transactions, we have what you call monetary assets and monetary liabilities. And then we have what? Non-monetary assets and non-monetary liabilities. So we have two class of them: monetary assets, monetary liabilities. Non-monetary assets and non-monetary what? Liabilities. Monetary assets include cash, debtors, loans. So these are some of the monetary assets: cash, debtors, and loans. So you giving loans to people. Are you getting it? They exist as money or as claims to specify sums of money. Holders of monetary assets suffer loss in the general purchasing power of their assets during periods of inflation. So when prices are going up, people who hold monetary assets, they lost big time. So I sell something for you, 5 Ghana cedis on credit. Then today, you say you pay me in 3 months' time. 3 months' time, the thing can be sold for 10 Ghana. Let's say sanitizer. I sold sanitizer for you. One full container. Let's say 10,000 Ghana cedis. Somewhere in January. But somewhere in March, one full container can be sold for 60,000 Ghana cedis. Miami. Meanwhile, I sold it for you 10,000. You have not even paid me up to now. That is what it means. So the example is that if one holds money in the form of a bank deposit and the yearly inflation is 25%, the loss on the purchasing power at the end is 25%. So it means that if you go and deposit money or you hold money, cash, you hold cash like this, or people are owing you, or you give loans to people, and prices of goods and services begin to go up, you are losing. Because by the time they bring that money to you, or by the time you use that money, you cannot buy the same thing you could have used that money to buy in previous time. So at the end of the day, these items, they are not affected when price of goods and services are changing, but the purchasing power goes down. So if the value is 100, the value is 100. Yes, then I sold something for 5,000. It is 5,000 I'll take from you. Price of goods and services are changing. Doesn't mean that if now it is 60,000, I should come and tell you 60,000. No. That is what monetary asset means. But monetary liabilities, such as creditors, bank overdraft, and long-term loans. Now, this is the loan you are going to take. The first loan is a loan you have given. This one is a loan you are going to take. As the value of monetary falls during inflation, it follows that the value of such liabilities in current value will fall. And this fall represents a purchasing power gain. So if prices of goods and services are falling, then you, the one holding monetary liability, you are gaining. That is basically what it means. So at the end of the day, they are asking you to explain what it means by monetary items and non-monetary items. When you pick the monetary items, you explain what you call monetary assets and tell us at the point in time where they gain or lose during price level changes. Then pick monetary liabilities. You give examples. Then tell us the point in time they gain or lose during price changes. I'm sure you have not read there yet, but maybe when you read there, you get more understanding to whatever I'm saying. Then non-monetary items and liabilities, such as fixed assets, stocks, and shareholders' equity, which are assumed neither to lose nor gain in value by raising or inflation. So these things, they don't lose or gain by view of inflation. Whether prices of goods are going up or they are going down, they don't lose, they don't gain. For example, if stocks on hand, you have closing stock at the beginning of a year, which becomes your opening stock. remain unsold at the end of the year, there will be no power loss, purchasing power loss, since one assumes the sales price when they are sold would be adjusted upwards to take account of the fall in the value of money. So what it simply means here is that if last year you have stocks you bought for 100,000 Ghana cedis, and this year you couldn't sell it, and next year you can sell it for 200,000 Ghana cedis, you sell it for 200,000 Ghana cedis. So if prices of goods and services are going up and you are losing, all you need to do is to increase the price and you sell, and then that is it. So we are explaining the monetary items and non-monetary items as used in the treatment of gains and losses when accounting for price level what changes. So you don't just explain the monetary items and non-monetary items and leave it there. You give the relationship between them when prices of goods and services are changing. Then there and there, you are in the process of answering the question. If you have any question, you gotta ask me and I will answer you. If no question, my time is up. So I'll disconnect and connect in the next 1 minute for us to finish this. There are most of the questions that are repeated over here. So I'll just show you the linkages and then we'll end the day. So join back in the next 1 minute, then we continue.